Welcome to Inside the Rope, the podcast where we speak to the leading minds in wealth management. I'm your host, David Clark, and I'm joined here for this episode with Tom Oriel. Tom, how are you going?
Yeah, good, David. How are you?
Yeah, really well, thanks.
Very good. Good episode today. Christian Baylis of Fortlake. It's not often that we get some sort of traditional bond-like portfolios on the podcast. What are the things that you're looking forward to in the episode?
Well, I was introduced to Christian and this strategy by a large family office who said, hey, you really should talk to this guy. He's really smart and we like what we're doing. And I took a look at it as a bond fund. I'm a bit, a bond fund. Yawn. We're normally looking for things that are a bit esoteric. And then I sort of looked at the performance of what he's been able to do. And yes, it's a relatively short time, 5 years. And his performance at 8.8% compound annual growth is okay, is good, is fine. But it's what he did in 2022 when the median manager, according to BlackRock in the bond market, remembering bonds are normally a buffer for when equity markets come down and equity markets came down, but bonds actually fell by between 12 to 16% somewhere, according to BlackRock in that year. And I think he went up by 7.28%. So I went, let's talk to this guy.
Yeah,
so that's what I want to talk to him about.
Yeah, good stuff. Yeah, very, very fascinating story. Launched it in the middle of the pandemic, walked away from, if the numbers are correct, $26 billion under management at UBS to go and start Fortlake. So it must be special.
Let's get into it. Remember that the podcast is recorded for information and entertainment purposes only. You're therefore encouraged to listen to the disclaimer at the end of the podcast. You are absolutely encouraged to keep your feedback coming. Please email me at david.clark@codacapital.com. Enjoy the episode. Dr. Christian Baylis, welcome to Inside the Rope.
Hey, David, thanks very much for having me. I appreciate it.
Well, I'm a little bit nervous today. I first time we have met, and looking at your biography and your history in markets, I can see that we've got the risk of getting very academic and deep into the weeds on this. So I'm going to do my best to keep it very understandable for all of our listeners. I think a good point to start off, as we would like to do on the podcast a lot, is really who is Christian Baylis?
Yeah, well, I think the only way to sort of figure that out is to take a step back, and I think your formative years is where a lot of the development happens. For those with kids, I think they would appreciate that point. And so as I think back, I was a very early adopter of sport in my life. So that was a very foundational element that stays with me today in terms of the lessons learned from that. I was a swimmer for years, from the age of 6 through to about 16. I probably swam about 10 kilometres a day. In my teens, I moved up to the Gold Coast to train with Dennis Cottrell, the famed swimming coach up there, and another coach, Alex Bauman, who was then the head of the Queensland Academy of Sport. He's a dual world record holder and Olympian for Canada. Spent a lot of time with him. A great mentor in my life for those formative years. Learned a lot of great traits through sport. Got to about the age of 16 and had just totally burnt out. Lost my way with sport. Was away from home for so many years up there training and just doing the hard yakka of trying to be an elite sports person. And I ultimately just collapsed at about 16 and had enough of it. And now these days I can't even go near a swimming pool. I've got so much PTSD when I go near a pool or try to swim. I actually tried to put some headphones on the other day, about 9 months ago, and tried to get out there and swim 1,500 metres. And I was like, I've just got to get out. So such were the memories and all of the hard work that went on back in those days. So anyway, that was what shaped me in the very early years. I then saying that, taking a step back, what actually took me away from it was, whilst I was up there on the Gold Coast, I was out there looking at the Nepean River up there and just saw a bunch of people rowing. And I thought, what an amazing sport. You're with teammates, they're speaking, they were having fun, they were doing cross-training. I said, I may as well give that a go. That was about a year after probably about 6 months after I stopped swimming. And just picked up an oar and loved it. And I guess because I had the background fitness from all the years of swimming.
The engine, the VO2 max.
Yeah, I was a 200-metre butterfly and did medleys. That's why I was training with Alex, because he was a gold medalist at the Olympics in '84 in medley. So he was the prime medley coach, really, which is why I stayed with him for so long. And anyway, went to rowing and just did that from about 17 onwards. Picked it up, loved it. Rowed at a few world championships, rowed in the Australian rowing team, was living at the Australian Institute of Sport, trying to do my studies while doing all of that. Met some great people on that journey, a lot of interesting people with very interesting mindsets. And that's what I love about sport is in that community, you really see a lot of people, you see a lot of champions, you see a lot of people that haven't made it, you see the defining features of what makes a champion and the mindset that's required. I found that really interesting. Anyway, so I did a few world championships in 2003. Devastatingly, I busted my back, fractured my L3 whilst I was at the Institute of Sport on my way to Athens and basically had to stop rowing, and that was the end of my rowing career. And I was gutted, absolutely devastated. It was the hardest moment in my life. It was almost 17 odd years of training, which culminated in what I thought would be going to Athens. And ultimately my body broke down and it was just devastating. I was just in bed for about 9 months. I had to lift up my rib cage to walk around. It was a very painful experience, not to mention all the emotional experience of not ultimately getting to where you wanted to get to. So very hard period. But fortunately, the culture in that sport was that it was an amateur sport, and I had really good friends around me, good mates who I have to this day, who would always say, look, you can't just be relying on rowing. It's an amateur sport to start with. You don't get paid a lot for it. And then, you've got to keep your study going. And so I kept my study going no matter where I was in Australia. I was pretty much living in every separate state because they always break up the crews into different states based on how many particular people from a particular state are in a crew. So anyway, that's how it worked. And fortunately, once I sort of got myself back together after that, I just doubled down on my academic work and just started to treat my academic work exactly the way that I'd treated my sporting work, and tried to apply the same mindset of, getting up at 3 a.m, doing the work early, basically structuring those same disciplines. And that really helped me fly through all of my academic work. The dean of the department came up to me and said, "Hey, you've got a bit of a knack for this math stuff and statistics stuff. Have you ever thought about sort of taking that a little bit further?" And I always loved maths and loved the challenge of maths and loved doing all of the sort of the mathematical puzzles and things like that you get when you're younger and those sorts of things. And really, so that was what led me into doing my PhD. Did my PhD in inflation forecasting and probability theory. Loved doing that. I just immersed myself in it. And then basically, went on to my first proper job was at Standard & Poor's as a rating specialist, which was interesting. Learned a lot about the financial world. Then went on to the RBA, the central bank. And I was probably like the guy in the back corner of the room that no one wanted to talk to, because I was doing an inflation. You would think of all places that would be the one place that you'd be accepted. Yeah. But back then, inflation just wasn't a word or wasn't a tier 1 economic data point that anyone cared about. And having done, I guess, a doctorate in inflation forecasting and all of the episodes that have occurred over the prior periods and whatnot, it wasn't a huge focal point. A lot of other things were focused on in financial markets at that point in time. But the great thing about going there, having that background, and the point in time that I was there, I was actually there during the GFC. I learned so much in the 3 odd years that I was there, because the plumbing ultimately broke down, and it was like having 10 years of experience crushed into 3 because everything just went wrong. So fascinating experience. Anyway, a few colleagues left there, went over to UBS. Obviously, everyone would know who that is. And I ended up going over there and working there for 10 years and sort of, I guess, learned a whole nother area. So I say I've had a pretty, I guess, broad sort of experience in the sense that I've done something different in each one of those roles. And what I found was that as I came out of UBS and started Fortlake, all of that culminated in so many interesting areas in which helped me to start the business, because you're pulling on so many of those prior experiences, even from the sporting side, from your first job to your central banking background to your asset management background. And I like to think that Fortlake's a bit of a collection of all of those sorts of things. Even the way that I think, I talk about the team environment. I've got pretty strong views on the team environment. Someone came up to me not so long ago and said, "Oh, we're a family," and I was like, "No, we're not a family. We're an elite team, and and that requires an elite mindset. If you wake up unhappy, I'm not going to kiss you on the forehead and say, oh, poor diddums. It's not going to be that way. That you've got to be a contributor to the team, and there's standards and there's goals. And like when I was in my rowing days, everyone knows that it's a conditional relationship, that you're in the team based on performance, and everyone has to hold up their end of the bargain. And that's really how I see that the work environment is. I think it's disingenuous to say that a work environment is a family environment. You are an elite team, or you're trying to be an elite team, and there's particular goals and processes and standards that have to go with trying to be elite. So I've really taken a lot of those lessons, those mental lessons from the sporting days, from the working days, and basically just tried to set everything up that way. So that's a very deep dive into
No, that's terrific. Exactly what I was after.
How I started and where I am.
And what boat were you in when you were rowing?
I was in the men's 8.
The men's 8.
Yeah.
And I don't know if many of our listeners are exposed to rowing, and I've been a little bit exposed.
Yeah.
And the one thing I would say is, a lot of sports that we're all familiar with, particularly in Australia and the team sports, you can always hide the person who's not feeling great or maybe can't catch the ball or anything. You can put them on the wing or somewhere else, and they can kind of trail around and be hidden on the, even the netball court, the basketball court.
Yep.
In the boat, there's nowhere to hide.
There's nowhere to hide.
If somebody doesn't turn up with their crook that day, the boat doesn't go out, or it's not balanced. If you're at the 1,500 metre mark and the boat's trying to surge and there's one person get a crab or not in time or it stops pulling, there is absolutely nowhere to hide. My son rowed at school and he just told me it was, going backwards hurting.
Yeah. And, I guess from a philosophical perspective, a lot of what we do as a profession is going forward whilst looking backwards.
Yeah.
So I often say, you've got to make decisions based off what you see in the rear view mirror, and the more contemporaneous you can be about that, the better off you're going to be in terms of your direction going forward. And it's very applicable in what we do. I always laugh at the parallel experiences that there are between, say, sport and what you're doing in your professional career.
I feel like you're being a little bit modest about your academic capability here. And I think it's really unusual that you get someone at an elite sport, at two sports, but then also is elite in academic. How elite in the academic side were you and have you been? I've read things and I've looked online. It looked like you had a perfect GPA and you had first class honours. Am I close to being right?
Yeah, that's right. But I would probably put that down to almost a bit of an OCD type of mindset based on the attitude that I believe that I had to have when I was doing the sporting side of things. So as an example, when I was doing my study, I'd be up at literally 2:33 in the morning doing all of the study, then going to do my day job whilst I was finishing off my PhD and these sorts of things. And just the mindset of trying to seek perfection. Obviously, you can never be perfect, but trying to strive for perfection, having a process and having a standard that you set yourself. It's not all natural skill, that's for sure. Yeah. It's hard work and it's hard yakka to do well in anything. And I certainly wouldn't hand on heart say I'm the most talented person in the world, but I believe I can outwork a lot of people, and I think that's really what it comes back to is I'm willing to work and suffer, and I've bizarrely found it a very comfort place in suffering, just from years and years of experience sitting out there in a lonely pool, going back and forth up and down a white line, or doing 6 hours of training a day when I was rowing. I found a lot of solace in suffering quietly, and you process the world in that moment. And so, I sort of took that approach to studying, and it really worked for me. And again, it's sort of
it's interesting. A lot of the high performance coaches talk about, well, everybody gets nervous, and everyone, the golfers. We had Jonah Oliver on the show, and he talked about, well, everybody gets nervous. It's just that those who get used to it and can perform at their top level, which become elite.
Yeah.
You did your PhD, you said, in inflation forecasting.
And probability theory.
And so, you flagged there you weren't that popular or the person, but you'd be the belle of the ball now, and where we are. When you were at the RBA, you mentioned there the plumbing had broke down. Talk to us about that and what you learnt at the RBA.
Yeah, well, I mean, ultimately the system was a mess. It wasn't fit for purpose. The banks had too much leverage. They had toxic assets on their balance sheet. They were exposing depositors to these toxic assets. And the financial plumbing just was not fit to deal with that amount of leverage in the system. And it was all premised on the world always running at a particular level of economic growth, or basically the world running at a capacity that ultimately was not sustainable. And what happened was, everyone knows the story, the world started to become a little bit of an echo chamber on things like leverage. I remember the phrases such as lazy balance sheets. It's not good to have a lazy balance sheet. You should have a gearing level of 70%. Most corporates were, doing, debt-funded capital returns in order to keep their leverage high. It was almost like the popular thing to do back then in 2006, 2005. And it all just came crashing down. And I think what is very different today versus then is we didn't have the alternative forms of capital that we have today. Back then, it was really the onus was upon banks to become the conduits of risk absorption in the economy. And they weren't actually really well built to do that because they actually have deposit holder funds. And they're a heavily regulated part of the financial system. And what they realised was that the regulation also wasn't probably fit for purpose. The structure wasn't fit for purpose. And they ultimately had to, I think, recalibrate the right types of leverage ratios. They had to recalibrate the right types of regulation, i.e. Basel 1, 2, 3, 4, that we've now gone through now, and the various iterations of regulation. And a lot of changes have come out of that environment. What we see today is definitely, I think, a reflection on what happened then and the mistakes that were made. And, people talk about the private credit world. That's a very popular topic at the moment, and alternative forms of capital. I think it was circa 6 or 7%. It was a cottage industry back then. So that the shadow banking system, as they used to call it back then, now is called private credit.
And what sort of level is it now?
In terms of, I think it's up to almost 20%, for a lot of...
So three and a bit fold growth.
Yeah. So as an example, I think from 2010 through to 2020, private markets have grown at a multiple of 6 times in that short period.
Yep.
So it's had a huge growth. But a lot of that is because that they realised that the system was flawed, and they needed to set up structures and vehicles which had consenting adults, i.e. wholesale investors, who were happy to take the risk off bank balance sheets. A lot of the bankers came out of banks and started up their own alternative asset management firms. So they had the requisite experience, a lot of them. And, the fish that John West rejects, or the suboptimal loans and the high risk capital type lending that banks were doing, have basically been parlayed off into firmer hands, in my view, and are ultimately in a better place. And so, so the system, I believe, is definitely better set up today than what it was. And so, my view is that if you're going to see a crisis in the future or the near future, it's certainly not going to come from the banking channel, because I believe that, they've harboured rude amounts of capital on their balance sheet. The regulation is much tougher. You've got a tough cop on the beat in terms of APRA here, and definitely the EBA in Europe and the Fed in America. And then I think there's been a regulatory catch up on the shadow banking system. We all know what that looks like, and they've done a good job of trying to catch up. They probably should have been more foresightful to know that if you're going to change the system that much, it's going to be like a game of whack-a-mole. Ultimately, the risk is going to pop up somewhere, and it's obviously popping up in another area, but it's not to say that makes it more risky. It could just be that the system's better equipped to deal with that risk.
Yep.
So I certainly wouldn't be calling out a systemic crisis because of the way things have now been structured, it could well be that the system is just in a better place to absorb that risk, and that makes a lot more sense to me, I think. So I think that's sort of a bit of a reflection on what happened then, the changes that need to happen. But going back to that point in time at the RBA, it was an incredible period, just seeing it firsthand, what was going wrong, the late nights. I think I used to get paid overtime back then, so I did a lot of overtime hours and got time and a half for my hours in. So yeah, a really interesting period, and just a great learning experience for a young person.
So let's change gears a little bit and talk a little bit about Fortlake in a minute. I think it'd be helpful if you could give us, why did you set up Fortlake? If I'm right, you were overseeing $26 billion worth of fixed interest and derivatives at UBS, in a great position. And then there was a pivot there to set up Fortlake.
Yeah.
What led to that? And maybe talk a little bit about Alex Weislitz and his involvement and how that came about and why you set it up.
Yeah. So look, I mean, after doing it for 10 years, I mean, look, one of the things I noticed, and it's no criticism of any past employer or anything like that, is going back to the first year that I was working in the industry, the amount of time that you would spend on compliance, governance, I guess the parts that weren't your core competency used to be a pretty minor part. As you move through to the 2020s, it became probably 80% of the workload. And in that transition, the client and the objectives ultimately take a back seat.
Mm-hmm.
Not only that, the microstructure of the markets had changed a hell of a lot because of what had happened during the GFC, i.e. we had clearinghouses, i.e. Banks have restructured their balance sheets, i.e. we've had the advent of much more private capital as a result of regulation. So the microstructure had fundamentally changed in the markets. I was dealing with a lot of insurers and ALM type clients, asset liability type clients, and they started to become very regulatory capital focused, and you had a huge divergence between your regulatory balance sheet and your IFRS balance sheet. Mm-hmm. And so I started to do a lot of work on bridging the gap between IFRS and regulatory. And what I also noticed in that period was a lot of the equity analysts went from focusing on IFRS balance sheets to focusing on the regulatory balance sheet.
And IFRS balance sheet is, sorry?
That's what you report to the stock market as an example. So that's your generally accepted accounting principle one, and you report that out. But in the background, the one that people don't see, the equity analysts don't tend to see as much, or they didn't back then at least, was the regulatory balance sheet was doing a whole nother thing. And so what equity analysts started to twig onto, they started to go, the reason this company can pay out more dividends is because they've started to release capital on the regulatory balance sheet. It actually had nothing to do with the IFRS balance sheet. So they started to focus much more on that other balance sheet, which was the one that was either sucking in lots of capital or releasing it if they were doing it well. And CEOs, particularly in America, and less so in Europe where you had Solvency II, the regulatory framework for insurers and whatnot, you found that people really started to optimise their balance sheets. And I did a lot of formative work in terms of trying to basically develop investment strategies that would be capital light, that would use the right the right parts of the capital markets in order to create that regulatory light approach. And we would do a lot of restructuring around things like inflation hedges to release capital for a life insurer or a funeral insurer or whatever, or taking away long tail risk in interest rates by, buying what we call receiver swaptions or something like this. These were all sort of tools or little instruments that we'd be using to release capital. So that sort of became my niche area of focus and the area that I really enjoyed doing. So long story short, I said, you know what, all of the great gains and the great P&L that's coming from these ALM/insurers is actually not coming from the boring old bond portfolio. It's actually coming from these new and improved areas or these more bespoke parts of the market. The bond portfolio, don't get me wrong, plays a role, and it's a great thing to have. It's just not where the magic is created. And so I approached, so I had the idea. Said, look, I want to go out, do my own thing. I've been in enough institutions now for long enough that I made the crazy decision right in the middle of the pandemic to jump out and
so November 2020.
No, even before.
Okay.
So I jumped out around. I think it was. You know what I remember? I think it was around March. I wanted to resign, and I was like, "Oh my god, the equity market's down 12% on the Monday. I might."
Yes.
My wife was like, "Are you sure that's the best idea?" So I said, "I might wait a month or two." So I think it was about May that I ended up going and doing something else and resigning and getting out. And it was actually a great time to set up a business, because over that COVID period, everyone was just like a rabbit in headlights. No one knew what to do. Everyone was like, "Where the hell's this all going to go?" And flows weren't going anywhere. No one was doing anything. Everyone's just sitting on their hands watching their current exposures. And ultimately, it was a great period just to set up the business, get all of the infrastructure set up, because it's hard going. So JP Morgan came to the party and said, we like the idea of an alternative bespoke type of solution. We'll give you $4 to $5 billion of balance sheet, which was a huge leap of faith for them because they hadn't done that before globally. Mm-hmm. So what they wanted to do was they wanted to ingratiate themselves at the grassroots of a startup asset manager, because it's very hard to do that in a more mature stage, meaning you can't get in there on the prime brokerage side. The trading relationships tend to be more embedded from the startup. So those relationships that you have at the startup phase just tend to get more ingrained. And so their view was, let's roll out the red carpet and give you all of the stuff you need to do this type of strategy, which typically you wouldn't get access to until you had $1 billion under management or something like that. Mm-hmm. They just gave me a lot of leeway, and with that came Alex, once those relationships were sorted. Explained it like I'm explaining it to you now, that there's a place for a more bespoke solution. Explained it to Alex that look, the fixed income / bond market is a commoditized era in my view, i.e. going back 20, 30 years ago, probably even 15 years ago now, you'd look at primary deals in the bond market and there was zero retail presence. As we move through to 2022, 2023, almost 20 to 30% of the primary deals are retail. And the reason for that is it's pretty easy. Mm-hmm. It's not hard to go and buy a bond. And I often say to people, if you want to go buy a bond or you want a boring old fixed income fund, just go do it yourself. Why would you pay an asset manager to do that? You're basically getting overpriced running yield. Mm-hmm. You're paying a fee for something you could easily do yourself. You even see there's an interest rate section in the AFR now. You've got stuff written about bonds all the time now. If you go back 20, 30 years ago, you never saw that. So the world become much more bond literate, fixed income literate. And my view was that in that part of the market, that's going to get commoditized, and that's not where you want to be. Even super funds were realizing that and in-housing and starting to get rid of asset managers in the garden variety areas of the fixed income mm-hmm. world, and saying, look, what I'll do is I'll do core fixed income myself and I'll do the more bespoke stuff outsourced. And so my view was that that's where the world's going, and that ultimately a lot of people would realise that they can do this stuff themselves, or they could basically get an index fund, cheap beta. But the part that retail and wholesale would never be able to do is the more bespoke parts that required credit approvals, that required a knowledge service. Basically when I say to people the difference between fixed income and equities is, in the more bespoke parts at least, you're offering a knowledge service that we're not a labour hire firm. We don't need huge teams, in my view. You don't need that, because it's ultimately a knowledge service. It's very scalable. You're playing unforced errors, not trying to get 10 baggers. Mm-hmm. I always say we live in a miserable parallel universe to the equity market. We're focused on unforced errors and downside. Yes. They're focused on getting the equity convexity. We don't get equity convexity, so it's all about the downside. And so it really needs to be a defensive type of posture in what we do, and that changes the way that you evaluate things and do things, and it also makes it much more scalable. Because
Christian, let's helicopter up perhaps a little bit for the benefit of the listeners, and just talk about that. What is bond investing? What is fixed interest investing?
Yep.
The traditional portfolio 20, 30 years ago would have been 60% equities and 40% bonds.
Yep.
And that was your diversified portfolio. And 2022 was a great example of why that is broken.
Yep.
But what's been a defensive part of the portfolio, what are we talking about there? Just break it out in real simple terms in terms of government bonds, corporate bonds, and what that looks like.
Yeah, so look, I mean, your standard boring old fixed income fund might have a bit of govies.
So
So
loans to government,
yeah.
treasury bonds in the US.
Yeah, exactly.
State and government, federal bonds here in Australia.
Yeah. So, and the way we break that up is you got government bonds, you got what we call sovereign supranationals, which are government affiliates, let's call it. You got semi-government, which is state government.
Yep.
And then you go down the risk curve and you go into corporates. You've got at the top end, your non-financial corporates, so your major banks is a good example. You can then go into your regionals. Obviously, they've got lower credit ratings.
And you get AAA rating right down through junk bond starts at what? Triple B?
Through, so yeah, double B plus.
Yep.
It's through triple B minus is where we start to say it's high yield or junk or sub-investment grade.
Yep.
And yeah, so that's sort of how it works.
So normally people, you're buying this bond, you alluded to, you're getting a running yield, you get paid a higher yield if it's higher risk. So in today's rate, what are you getting paid for an Australian government bond?
Oh, so you're probably getting around about 4.5%, something like that.
Okay.
Above the cash rate.
And then if you go out the risk curve to a lower grade corporate, you're getting paid about how much?
Yeah, so you're probably getting paid about 90 to 100 over swap. So just think of the swap rate very close to the cash rate, which is currently at 4.35 for a stylized example.
Yes.
So you're getting about 100 basis points just say above the cash rate.
Okay, so the idea was you'd have your equities part of the portfolio where you get your growth and your capital growth and a bit of income from dividends, and that would be quite volatile. But you'd have this part of your bond portfolio to be a ballast to that.
Absolutely.
And that's kind of disappeared. But what you're also saying is on this defensive side of the portfolio, that's anyone can go and buy all those bonds that you're talking about and just hold those yields and get that if they hold that through to maturity. Your view is that there's an extra layer to that which can enhance. Now talk to us a little bit about that extra layer and what do you mean by that?
Yeah, so what you found is that with things like clearing houses as an example, we can now effectively go and take credit risk through an index. Let's call it a CDS index, which is basically an insurance product, which allows us to protect the portfolio. And that doesn't sit with a counterparty; it sits with a clearinghouse. So it's a quasi type of risk-free structure that's been put into the capital markets that didn't exist as we go back to 2007, 2008. Now that's become, in my view, a much more efficient way of implementing sort of protective types of trades in your fund. So as an example, we were talking about if you had that boring old non-financial corporate portfolio that you just referenced, and you got a bit nervous about wanting to protect it, or you thought defaults were going to pick up, you could go and buy default protection, and that would be cleared, meaning that you basically don't have to have a bilateral arrangement with a bank, because we all know what happened there during the GFC. You'd have a bilateral relationship, and you'd buy protection against a particular corporate or an index of corporates that you thought would hedge out your corporate portfolio. But then you end up realizing that you've got Goldman Sachs risk, because all of a sudden they're a systemic risk and they're in trouble. So that the heavy lifting that they did was to create clearinghouses. They basically reduced the probability of default in clearinghouses by bringing that down to almost a 0% probability of default by pumping as much capital as they possibly can to, with all of the associated guarantees from counterparties and these sorts of things. So they are as good as a risk-free solution to basically pay out the cash flows on those types of things. And that's been a huge microstructure improvement in the debt capital markets. And what that means is that also means that now things like the default market has become a fully functioning, very liquid market clearing type of arrangement, where no longer are lawyers processing defaults. If you go back a few years ago when Virgin defaulted, went into VA, who gets all the money? It's the lawyers. So the cents in the dollar that ultimately goes back to creditors, it was a minuscule amount, because there's millions and millions of dollars of legal fees. Now, if we fast forward to today, we've got a clearinghouse which says these are the rules of engagement. If you are in the capital markets, this is the way it works. So you opt in as an issuer, and you opt in to the way that that's going to basically work. And the people that buy the protection on these things also opt in. So it's basically a standardized model. And when you standardize something, you ultimately get huge amounts of liquidity, a huge pickup. Even in the bond market, all of the major banks typically issue with standardized docs, standardized clauses. And the reason they do that is because it makes it simpler for the end investor. By making things simpler and more standardized, you get more liquidity. So long story short, what that means is liquidity's picked up. You've got a market clearing mechanism to process defaults. You've got basically a very quick solution which doesn't involve lawyers. And basically from the point of default to the point of when you get paid out for your insurance can literally be a few days. So that allows you to build strategies around these types of things because you now know when your cash flows are going to be paid because it's being paid by effectively a risk-free entity, which is the clearinghouse, not by a bilateral counterparty who might try to wiggle out of it or do something like that or gets into trouble themselves. So that's just one example of many where, and the same is applicable in interest rates. We've now got cleared swap markets and these sorts of things, which also makes it capital light, i.e. you can put small amounts of capital against this type of stuff and you can ultimately introduce non-correlated types of return sources into your return profile. So you've got, just think of it like this, you've got the boring old bond portfolio, you've got these non-correlated types of return sources that don't take up a lot of capital and they're complementary because they're typically going the opposite direction to the risk that you're running in your bond portfolio. And that can really reduce your correlation. So when people ask me what does alternative fixed income mean in your world, I say, well, basically you look at the correlation through time, and if you've got a negative to low correlation versus risk assets, credit, equities, that means that you're ultimately using some of these alternative return streams that tend to come up when those other things are underperforming. That drives correlations lower relative to those other assets. And so what you're basically saying to people is, you're going to be the thing that people can rely on through time when some of these other things maybe through time aren't performing as well. And we're going to provide you an alternative return stream to what those other more well-known assets actually do. So that's a little bit about the old world and how the new world's progressed. But it's easy to get very deep and in the weeds on this stuff and start to complicate things too much.
Absolutely.
But yeah.
Christian, interesting. I alluded to Alex Weislitz, who's he's a board member now and one of your founding shareholders, I'd say, and involved in the start. I didn't know a lot about him, and I checked about, and of course I knew Thorney Investments.
Sure.
And it seems to be that he's sort of almost known as Australia's Warren Buffett. Started in small cap investing with circa $1 million, turned it into over $1 billion.
Yep.
If you were to ask him why he got involved in Fortlake, what do you think his answer would be?
I think he saw what I saw, which was the market opportunity, and he understood the framing that I put forward to him, which was, this is a commoditized market. It's not that difficult. There is a place in this market to ply your trade in an alternative way, which isn't going to be commoditized and ultimately would never become commoditized in my view, because it is a real niche knowledge service, i.e. it's like saying a particular type of surgery is going to be always niche, i.e. brain surgery. Not to say that we're brain surgeons, but
Correct.
It's always going to be in the hands of the people with deep knowledge in those areas. It's never going to be mums and dads doing that stuff.
So he saw a value proposition that was defendable over a long period of time.
Absolutely. And he did respect the fact that it was alternative and that it's just not another bond fund. And I always say the last thing the world needs is another bond fund.
Okay.
That's not what we went out.
Fast forward from 2020 now, 2026, how have things gone for you? You've got 3 strategies, right?
Yeah.
How has the rubber hit the road, so to speak, in performance?
Yeah, performance has been great for almost the last 6 years. I mean, I think every year with, it's all the funds since inception are circa 9% net or close to it.
Mm-hmm.
And that low correlation is 0 to negative on all of our funds. And just for the listeners' benefit, the way that we set the strategies up was we have 3 funds, all with different risk and return profiles.
Mm-hmm.
So we've got our staple dish, which I call it, which is our real income fund. That's the most optimal from a risk and return perspective. And I always, when I'm talking to clients about, which fund should you go into or whatnot, I always say, look, that's the staple dish. That's the best one to go into because it's going to give you the best risk-adjusted return out of all of the funds that we have, for the simple reason that it's, if you think about those old university efficient frontier graphs, it sits right at the point which tends to push risk the right amount to get the required return to deliver the alpha target.
Okay.
And then I leave it up to people in their own discretion.
Yes.
If they want to go into the higher returning, higher vol stuff, that's their choice. But we always try to guide people back to the real income
So
fund.
the other strategy is a higher income, and then I think
the Sigma fund, and they've got much more punchier return targets and vol targets as well. So you've got more loose rope, is how I like to couch it, to generate the return. That means you get more vol in those types of products as well.
Okay, so let's talk about the real income fund, the stable, the staple dish you're saying there. Funds under management over the three strategies in total about how much?
Yeah, we're close to 2 billion now.
$2 billion
across all of them.
And how much is in that sort of staple, that real income fund?
Yeah, that's very close to 900 now.
Okay.
Yeah.
So what is the composition of that fund today, roughly speaking?
Yeah, so it's 90% bonds. So that's what we use to anchor.
And how much of that government bonds versus corporate?
So govies are running at zero right now, and we're running much higher on, say, bank exposure. So it's got a lot of the major banks. The average rating of the portfolio is A-rated.
Okay.
So we keep it pretty high up, and as I said, it's about avoiding potholes. It's got a running yield of circa 5.3% on it. And really the whole point of that particular part of the portfolio is to pump as much diversification into it as we possibly can, avoid concentration issues, avoid speculative types of positioning in particular names, because our true belief is that all credit is ultimately equal when you get a dislocation, is active alpha in the world of bonds. In my view, is a little bit of a myth.
So it's diversified geographically, Australia, US, Europe.
It's predominantly Australia, for the simple reason that we pay out Aussie dollar distributions to our end investors.
Okay.
So if we do anything offshore, we'll typically do it through swap markets because it's more efficient from a currency perspective, and we don't like to waste frictional costs on doing offshore hedging and these types of things. So we're very cognizant about the way in which we manage currency and doing it the lowest friction point.
So bonds were about 90%, did you say?
90%.
And then what's the other 10%?
Then you've got 10% of cash, which supports what we call the overlay activity.
Yep.
That 10% supports the things like the default strategy and whatnot. And so we use that 10% to basically go out and reduce the correlations in the portfolio. So
how many different strategies would be in that?
Yes. So the way that we characterise it, we've got three ways in which we generate money. We've got the boring old bond portfolio, which, as I've explained, is pretty simple. You then got what we call the macro overlay piece, which is basically you've got interest rate management, curvature, which is basically differences between
the expectation
of different parts of the curve. Exactly right. Inflation hedging. And then we've got macro credit, which is basically using indexes to manage credit risk in the portfolio. So that's two areas. The third area, which is the part that we're really well known for globally now, where we've got, mandate money and people are often talking to us about, is the default strategy. That we call it default arbitrage. That's a fancy word for basically harvesting defaults, going into the weeds of the high yield markets in the US and Europe in particular, and trying to pass on the benefits of defaults and using that as a non-correlated source of alpha. And what we're expecting to get through time is we want to get as many positive months since inception. So in the real income fund, we've had 85% positive months since inception, and the upside capture has been 3.5 times greater than the downside capture. So they're the metrics that we look at, that when we have upside months, we want them to be 3.5 times greater than the downside months, and we want a lot more of those upside months. So we're trying to create a return asymmetry, and that's how we judge the success of the strategy. And as we move up into the other products, we expect less positive months and more negative months. So we'll go to 75% positive months in those other funds. But in the real income fund, we're ultimately just trying to keep as stable as possible and trying to get ourselves to the doorstep of the default opportunity in good shape, that when those defaults ultimately pick up, you'll get this burst of capital coming through the portfolio. So the perfect type of environment for us would be a 2020 type of scenario where you had 20 defaults in the capital markets that year. We should get a pretty good return in that type of environment. And that's really what we're trying to do, is we're trying to use the boring old lazy running yield in the portfolio, get yourself to the doorstep at the opportunity of a default. Sometimes that happens in a correlated way. Sometimes it happens in an idiosyncratic way, like what we're seeing at the moment. And you'll get these bursts of capital, and your return profile will look pretty good when those defaults come through. So that's really how we've structured the funds, and pretty simple, really. Three core ways you make money.
I like the way you call it simple. Tell me, from a diversification standpoint, how many total positions would be in that portfolio?
Yeah, we've got about 650 positions.
Yeah. So this is interesting, right? And how do you manage that and identify particularly the global
Yeah.
default swaps? Is there technology involved? Are
Yeah.
you leaning into AI?
100%. So the technology build is huge. I think we've spent around $2.5 million on building the appropriate risk systems, and that's always under constant development. That was the biggest piece of infrastructure, and that's the barrier to entry. So people often say to me, well, if there's an arbitrage in defaults, why isn't everyone else doing it? And you go, because a lot of people are on off-the-shelf type platforms like Aladdin, these types of things, and a lot of them aren't great at dealing with the complexity of the default system in terms of CreditX and how the auctions work, and how different parts of the default system actually work, because it's a very binary type of area, which can be perfect. I always say it's a bit like Queensland, perfect one day, terrible the next. It can just blow up, and you've got to know how to manage that risk pretty well in terms of the defaults. So the technology is huge, and then in terms of managing the scale, I always say it's a bit like an octopus. We've got tentacles out there, but we don't want to put our tentacles into anything where we don't believe we can appropriately resource it, or we don't believe that we've got a competitive advantage, i.e., I don't believe we've got a competitive advantage in generating repeatable alpha in boring old corporate bonds. I believe that that's basically a beta argument, and we're better off just declaring that and saying, look, that's not our core advantage. We believe we can do it well, and we believe we can play without unforced errors. Been doing it for 20 odd years, but really where we think we can add advantage is where we can add
Value.
Our value is in these particular areas which require a lot more technical knowledge. It requires systems, and we just don't see anyone else doing it. We don't really believe we've got a true competitor in that part of the market, and that's certainly the feedback that we get from other people that are out there who see a lot of these types of managers.
Well done. Super exciting. Well done. And would remiss of me not to ask. The bell of the ball with your thesis and your inflation point of view, and it's interesting. Inflation, is something that people are having to deal with since COVID. That before was very nascent for lots and lots of times. What's your view of where we are at the moment?
Australia specific or globally? Yeah, look, I look, Australia's an interesting one. My view of it is, look, obviously we didn't start in a good place. I think if we look at the lessons of the past, if we go back to the Phil Lowe era, Phil, lovely guy, doesn't have an egotistical bone in his body. He made a general statement and was, I think, was unfairly castigated for it. And I think in my world, I knew exactly what he was saying. The central estimate, which is basically the forecast, but I think the media doesn't appreciate that you've got 3,000 possible outcomes around that central estimate, and he was just being quite academic about it, and the media have pinned him on what would most likely happen. Obviously, it didn't happen. We were coming out of a pandemic, one of the most uncertain periods of the world that we've ever had in the world, and ultimately, I think the failure there was you need to switch your mentality as a central banker from moving away from forecastability and giving guidance to pure risk mitigation. And I think central banks had not had a regime change like that where it required a different approach to say, okay, we need to move early and we need to basically get on top of this problem very quickly, and we actually need to move harder, earlier, faster, and knock it on the head. Like any type of illness, I always say it's a bit like antibiotics. You want to finish the prescription, and the earlier you start and get on top of the sickness or the illness, the quicker it goes away. And I think there's always a tendency for central bankers, because they're people, they don't want to disappoint. They've made prior commitments to people as it sort of was portrayed in that particular example. And I think that ultimately played out through inflation. And the only reason I bring that up is because I think a lot of that is why we are where we are today, why we are here today, is because ultimately we didn't do the heavy lifting that we needed to do back then. We allowed the illness to fester under the surface. We only pushed the cash rate up to 4.35. We needed to go further. We didn't do that because I believe the logic was that then they said they used the other part of their remit, which was to go and target the labour market, because this is another gripe I have with, I guess, not the central bank, but the rules that are thrust upon the central bank is central bankers should not be in charge of the labour market. That should not be part of their remit. And what that does is it affords them, and they can use subjectivity to switch from their core manifesto, which is inflation, across to the labour market where they don't have direct control. You've got payroll taxes, you've got labour laws, you've got unions, you've got the power of the purse influences the labour market. Why would you put the responsibility on a central bank to manage that? It is just so disingenuous. And I think it comes back to politics. Politicians love to say, it's not me, it's over there. It's the Sergeant Schultz type of response. I know nothing. It's over there. It's with you, Phil and Michelle. And the reality is the mistake they made was they then said, we think we're job done on inflation and we're now going to target the labour market. That was a big mistake because other central banks don't do that. The ECB does not have a labour market remit. The Bank of Canada does not have a labour market remit. The Bank of England does not have a labour market remit. Their core reason for being is basically targeting inflation. So here we are today. And what has happened is it has come back and we didn't get on top of the problem. We didn't actually push it into total remission and it's allowed to gather steam. And I think that's very obvious now because what you see is we were definitely, before Iran happened, we were at 3.7% inflation. We were probably the highest in the developed world in terms of our inflation level. We had one of the lowest real cash rates in the developed world. Actually, our real cash rate went negative, which basically means we don't have any tightening in the economy. And so we started it in a very weak position. Now, then what's happened is you've had an upside shock, a surprise. No one knew that was going to happen. And now we've been chasing our tails. And I think to the credit of the central bank now is they've moved very early to try to get on top of the problem. And they've bumped it up 3 times. They've gone back to back to back up to 4.35. And I think what we're starting to see is inflation underlying is probably starting to moderate a little bit, or at least the vital signs are starting to tell us that there's, a little bit of softness in the labour market. There's a little bit of softness around GDP growth. There's a little bit of softness around sentiment. And probably that means that inflation is getting to a point where it might be starting to moderate. Now, the only issue is that the central bank's relying on a forecast out to 2028 to get back to 2.5%. And I think that's a hell of a long time to sort of stick your thumb up in the air and say, hey, we think that this is ultimately going to happen. We're in a very uncertain world and I wouldn't be comfortable relying on forecasts out to 2028. I always think the path of least resistance is just to make sure, get the job done, focus on solving the inflation problem, which we've clearly got. And when you've conquered it, then you can go start to focus on the labour market and those sorts of things. But the number one priority has to be price stability. And I often get asked the question, why is that? Because guess what? 28 million people suffer higher prices. And that doesn't make a lot of sense to me to have frictionally 50 or 60,000 more people employed for the sake of 28 million people paying 1 or 2% more via a cost of living, the tax. Inflation is a tax. You're effectively saying, I'm going to prioritise particular segments or people in the labour market, which again, I don't think should be the judgment of unelected officials. And I'm going to ultimately allow 28 million people to pay more. That logic just doesn't.
It sounds like you're saying you think there should be more rate rises. Do you think they'll deliver those?
I think there should be. I think 5% would absolutely nix the problem. Now, I'm not stupid enough to say that might not cause other problems. It's how certain do you want to be? Do you want to be risk-free on that mindset? I think going up to 5% would unequivocally solve the problem. What you find with central banks, though, is they don't want to be unequivocal, is they want to have a foot in both camps because if it goes down, as I said, they're people, they don't want to look wrong. Now, you've got some more cavalier, let's call it, central bankers out there. You had, back in the 90s in the US, or back in the 70s and, and that sort of period in the US, they were fine to push interest rates up and be quite brazen in terms of just absolutely trying to crush inflation. That has side effects, and so we've got to keep all of that in mind. But if I was in their shoes, I'd probably go one more and then sit. At the moment, they're sitting at 4.35. I don't think they're going to hike in June. I think if they don't start to see some proper progress by August, I think August is a live option, and they may still go there. But again, what we've got to focus on is we've got to focus on the real cash rate. What is the actual level of tightening in real terms that's happening in the economy? Because the central bank only can control one part of the coin. The other part of the coin is the inflation level, and that is the part that ultimately moves around the real cash rate. And so you do have to respond to changes in the real cash rate through a policy lever. That's really what they need to be doing now. You don't need to do it, too minutely. You can be a little bit patient, But if it starts to get away from you, you've really got to get on top of that quickly. Otherwise, it becomes entrenched. We all know the story, and then you can't get on top of it. So that's sort of my view on inflation and the backdrop and the I guess the remit that they've been given, which does make it, I think, a little bit harder for them. Yeah.
Hey, Christian, thank you very much for your time. I've really enjoyed getting into the weeds here and understanding the differentiation of your portfolio and your strategy. Congratulations on all the success you've had and having the guts to step out and form that Fortlake business back in 2020. Thanks for joining us at Inside the Rope.
Thanks, Dave. Much appreciated.
Well, welcome back. I hope you enjoyed that episode as much as I did. Tom, what did you think of it?
Yeah, really good episode. I think to start with his background in elite sport, swimming, even though it has some deep scars, it looks like, left on his mind from the training he did back in those days, and then taking that into rowing. It's like two of the toughest sports in terms of training that you have to go through, and the process behind that into then ultimately managing money was really fascinating. So I think he was saying that, a team, the elite sport sort of thing is that it's an elite team. It's not a family. It's conditional. It's performance-based. He's a hard worker. So just his insights into that were fascinating. What are some of the key things you took away from it? Yeah,
look, I'm keen for us to try to introduce a bit of structure into how we think about this. So maybe if we go through a lens where we talk about, the founder, principal, key portfolio manager in this first, talk a little bit about the strategy and then the sort of structure of how they're proposing the investment, and then ultimately the track record. These type of things are always filled with, past performance isn't a gauge of the future performance, but in many cases it rhymes or is indicative of that capability. But if we start off and think about the alignment of interest or the principle, I think he's clearly really smart. He's almost
doctor.
He's almost like a polymath in, an elite swimmer, heading towards the Olympics, then an elite rower, rowing for Australia in the 8. And both of those sports, the mental focus that you need, and as you flagged, the application is brutal, right? And then applying that into math and working hard. So I really, really like that part of it. I see the alignment of interest between him and some of the management team. It's a pretty small management team. So there's a bit of key person risk around that and what they do. Chip in here where you want. On the strategy side of things, I think this is where it's really interesting. And if you look at that 2022 result, the way I think of this is a stock standard global bond fund, 90% bond fund, right? It's almost an ETF. And just say these guys can run it just as well as an ETF. That's fine.
And that is the question. It's like these days you can go and buy a Vanguard bond index fund yourself within 5 minutes.
Yeah.
So what does that 10% deliver?
Yeah. But it comes with an insurance policy is how I think about it. This CDS and these credit default swaps, and it's actually quite complex when you pull it apart.
Correct.
But what that allows you to do is to trade away a bit of your running yield, the yield that these bonds are paying you on the way through, to have when markets have dislocation. And, in 2026 alone, I can think of, 10 type of events that could have been a big major dislocation. So I wouldn't be surprised if we have some of those in the future, and it gives you that insurance. I know Merrick's has a similar in their private debt strategy, which smooths returns. And that's how he's gotten those returns in 2022. So I like the strategy.
It is interesting, though. Like you said, it is quite complicated. And it's sort of, we've met with a team and they said, it's like a put option on the high yield index. And it's like, well, it is, but it isn't. There's a lot of risk associated with, going through a credit default swap situation. When there is a credit default swap, flagging it to the clearinghouse, then having that assessed, then going through an auction, then getting the payout done. There's a lot of these mechanics and other underlying risks. It's not like a strike price getting hit on a put option. So they've traded a lot of that away by using an index, and I think that's fine. But it is worth flagging that the risks aren't the same as just a traditional put option. So there are some complexities in there that are involved with that. But it is fascinating. I mean, what they were able to deliver in 2022 when bond markets did come off, as you said, and to outperform by having that underlay in there, it's quite, it's quite amazing.
And then if I look at the structure and management, the fees are somewhere around the 0.7, I think, maybe a little bit high, but, the performance net after that seems to, support that. Day one liquid, big tick for a lot of investors to be able to have that optionality. Having JP Morgan behind them, who, sort of committed very early as if they were $1 billion organization, is also, a bit of a tick in that sort of structure around that as well. And then ultimately the track record, look, it's pretty short, 5 years. But over that 5 years, what was it, 8.8% net back for this type of, the safe part of your portfolio? That's pretty good. That's really good.
Yeah.
But what to me is the most impressive is that 2022 number. It'll be interesting to see next time we have a crisis how it performs.
Yeah, absolutely. I think the other things that he said, there were sort of two other key points that I took away from it that I found really interesting. One being that, the banking system is structurally a lot safer now following the GFC. But he flagged, the risk hasn't gone away. It's just changed hands. It's moved from the banking sector into things like private credit, which we've had a lot of on the podcast in the past and a lot of in client portfolios. And when those defaults pop up, which they will have, and I think a lot of their data and analysis is showing that over the last 5 years, those defaults have increased steadily year on year. That's going to be happening at the expense of some of these private credit providers. So where this sits alongside other sort of managers in client portfolios will be an interesting point for advisors and clients to think about in the future. But yeah, their performance has been fantastic. And I think being able to sort of have that insurance underlay in there when things do go wrong, like in 2022, is really helpful. And then the last point was just on the inflation thesis. He has a good track record at the RBA. He worked at the RBA, I think, when he came out from university. And he was saying, they really need to hit the nail on this inflation. The RBA should be putting the cash rate up to 5% to sort of bed it down and nip it in the bud. But also acknowledging, look, we have to do that, but there will be consequences, and I'm not shying away from the fact that there will be implications if they did raise rates to that level. So just another interesting point.
Super interesting. He wrote his thesis, I think, on inflation.
Back when no one cared about inflation.
That's right. It hadn't been around for so long.
Yeah.
And I thought it was also fascinating that he called out the difference in mandate in Australia that the RBA has that includes full employment. So, maybe that's from a structural point of view.
And using that as a scapegoat for not raising interest rates.
Correct. So, interesting, there might be some structural buffers in that. Okay, all done?
Yep, I'm done. That's it. That's all from me.
Well, thank you. Some great points there. And thank you for listening. I hope you enjoyed the episode. Remember to subscribe and share and keep the feedback coming. Thanks a lot.
Thank you for listening to Inside the Rope with David Clark. Be sure to subscribe to this podcast on iTunes. You can connect with David by visiting codacapital.com. Any views expressed in this recording represent the personal opinions of the speaker and do not represent the view of any other party. If this recording contains reference to any financial products, that reference does not constitute advice or recommendation and may not be relied upon. Listeners in Australia are encouraged to visit www.moneysmart.gov.au to obtain information regarding financial advice and investments.